Bank of Canada cut 50 basis points. Happy holidays and Merry Christmas to those Canadians with a variable rate mortgage as they continue to watch their payments adjust. Canadians that have been holding on to their variable rate mortgage are actually breathing a sigh of relief with Christmas potentially coming early. But what does this mean for the broader economy and ultimately what it means for Canadians applying, renewing a mortgage in 2025 as we close out this chapter of 2024 with the Bank of Canada's last rate announcement? What can we expect or anticipate in 2025 after the most recent press conference for the Bank of Canada with Deputy Governor Karen Rogers and, of course, our Governor of the Bank of Canada, Tiff Macklem? Will unpack our thoughts and opinions this week. Welcome back to the channel. If you have not subscribed, well, we invite you to subscribe to the channel, hit that notification bell. Don't forget to leave your thoughts, questions, and concerns in the comments section below. But let's get right into it. Ultimately, the Bank of Canada cut 50 basis points. That brings the overnight lending rate for the Bank of Canada down to 3.25, ultimately changing the banks, most of the major banks, actual policy rate or their prime rate to 5.45%. And this is really good news for a lot of Canadians that have a variable rate product with a significant discount. What we've been noticing as we've been talking about these potential changes, these potential rate cuts by the Bank of Canada, is more and more Canadians actually opting into a variable rate product to take advantage of the Bank of Canada's further discounts or further rate cuts, we should say, that could be potentially or gradually coming through in 2025. When we talk about where things are headed, well, we talked about it last week. Just to do a little refresher, we basically argued that the Bank of Canada needs to cut 50 basis points. And, some people may have agreed or disagreed with that sentiment. But at the end of the day, the economy, the current state of immigration, the current unemployment numbers, the labor force, tell the Bank of Canada that they needed to go 50 basis points. In their press conference, they obviously waffled between 25 and 50. Ultimately, the outcome was 50 basis points with the indication that they will maybe gradually slow down those rate cuts in 2025. But I have a inclination that that may not be the case, because keeping in mind that the Bank of Canada governor did point out that growth GDP has stalled out. We are still growing, according to the governor of the Bank of Canada, at 1%, not where they want growth to be, but ultimately they're still growing. But we are seeing contraction in GDP and GDP per capita. So obviously that does lead the Bank of Canada down that path to really wonder what's going to happen. And they even pointed out that growth is going to be weaker in their forecast because of the fact that immigration levels are changing. They're anticipating a lot of people to be leaving the country, which means they will be leaving the economy, and that will obviously have a implication on the growth in the economy, right? Less people in the economy, less people spending, less growth, less production. I mean, ultimately, this could help with the labor concerns. But as we touched on last week, what is the likelihood of a lot of these people actually leaving? Those students, those temporary workers, are they going to apply for a refugee status, asylum status? We'll have to see how that really plays out. Now, with the policy rate, obviously the Bank of Canada governor re-emphasizing that if all of the data aligns broadly with their expectations, it's not unreasonable for the Bank of Canada to continue to cut. It's very important to understand that they may gradually ease the cuts. Maybe we won't see those 50 basis point swings. We saw two back to back, but we may not see a 50 basis point come in the new year right away. It all depends on what ends up happening with inflation. The Bank of Canada governor once again reiterating that they believe that the policy rate is in restrictive territory. Now, sometimes we get questions, what do we mean by restrictive territories in regards to the policy rate? Well, you have to think of the Bank of Canada looking at the economy, looking at consumer spending and businesses and capital coming into the country, trying to drive business growth. If our policy rates are too high, that's not going to allow people to deploy money, capital into the economy. I mean, people are going to be a little bit more conscientious about spending, especially in the Canadian economy. And that is something that the Bank of Canada governor, as well as the Deputy deputy governor and I'm assuming the governing council are going to be paying close attention to as we see some the debasement happening between the Canadian and the US dollar. Now, ultimately, this is a point of contention for a lot of viewers. Yes, the Canadian dollar could potentially weaken further, but we've definitely seen a Canadian dollar still hold pretty steady, even with the most recent cuts. Ultimately, we'll see how that plays out over the next little while with this additional 50 basis point cut. But ultimately, I really do believe that the Bank of Canada, looking at monetary policy, looking at the state of the Canadian economy, is willing to potentially allow a little bit further of a debasement that could be making Canadian exports, right, what Canadians produce here, more lucrative or actually better priced for Americans or other places in the world, right, when they buy the Canadian goods. However, yes, the counter argument is as Canadians buying from the U.S. in U.S. dollars, it's going to be more expensive, inflationary by nature, obviously, because you're paying more as you bring in these products. But we'll have to see how this plays out. Another point that the Bank of Canada governor had mentioned very clearly is that they cannot forecast a potential tariff that could be impending on January 20th with Donald Trump coming into power. Obviously, that is true. We can't really, actually, we can pretend that 25 basis points will come into effect, but they can't actually base the economic conditions on that 25% because there could be sanctions, there could be obviously some exceptions, there could be obviously some Canadian, the actual Canadian government may actually try to battle that and retaliate against that. So we'll see how those measures play out. And I think that will be a very important conversation come January. Speaking of January, obviously the 29th of January will be the next Bank of Canada meeting. Prior to that, on January 20th, we're going to get a super important piece of data from the Bank of Canada. Obviously, that's the Business Outlook Survey. We're going to get the Consumer Outlook Survey as well. And that's going to give the Bank of Canada a lot of direction on where things could be headed for the 29th when they decide to cut rates or if not. And more importantly, what's going to happen with inflation. Bank of Canada pointing to inflation, like we've talked about, bouncing in and around that 2% mark. That's what they wanted to see, right? So we sort of argued that, hey, that's the cover that the Bank of Canada needed, right? If it was higher, then they may have cut a little bit less. If unemployment didn't take up to 6.8%, then they may have not cut 50 basis points. But, we don't see, as the Bank of Canada pointed out at the press conference, widespread layoffs, but we are seeing that number tick up. We're seeing obviously more people looking for jobs, less jobs being created. And if we extrapolate that data, that could potentially be a major problem in a few months. Remember, everything works on a lag. All the data, everything that the Bank of Canada is looking at is not a leading indicator. For the most part, it is always a backwards looking indicator. It is like trying to drive your car forward by looking in the rearview mirror. It's very challenging to make the right call. And ultimately, the Bank of Canada has a lot of work cut out for them. And I think this sort of points us in the direction, okay, what's happening with mortgages, what's happening with real estate. We really understand that the Bank of Canada is not directly focused on housing. They look at the housing component as part of indications of what's happening with the economy, inflation, obviously consumer spending, as mortgages are a big spend. On a side note, obviously the Bank of Canada, just before we get into it, shelter cost has pulled back as these variable rate mortgages based on lower policy rates by the Bank of Canada have led to cheaper payments for some Canadians that are holding on to variable rate products. Fixed rates have dropped significantly over the past little while. We still continue to see some of that stickiness, but for the most part, they believe shelter cost inflation will be pulling back and other durable goods sections have been pulling back. So the Bank of Canada, as I mentioned, previous videos, the Bank of Canada believes that inflation is going to trend to that 2% mark and stay there. So we have to keep that in mind as the Bank of Canada continues to mention, Deputy Governor Karen Rogers, sort of isolated out on that conversation and question about housing. And ultimately, they have pointed to the fact that housing activity has picked up. Some people saying, no, it's not, it has not. Okay, whatever the case is, the Bank of Canada is pointing it out.
What we've seen in housing recently is a pretty big uptick in activity, and it's come without a commensurate uptick in prices. So that's actually been quite good news. There's some mortgage rule changes to come, another 50 basis point cut. And we know housing is very sensitive to interest rates. So we do expect some more pickup. Whether the immigration reduction in immigration will sort of act as a counterbalance to that, that's very possible. We'll have to keep an eye on it. But so far, an increase in activity without an increase in price is a good thing for the Canadian economy right now.
And the one thing that they've also pointed out is that housing activity has increased. We're not saying prices, right? We have to disconnect activity, people getting into the market, people buying, but we haven't seen that correlate yet into higher home prices. That's the important part, right? Home prices may remain level. They may stay flat. You may see some homes sell for less than list. That's fine. I mean, that's a good thing, right? We don't want home prices to basically go parabolic. We want them to stay flat and as low as possible to maintain housing affordability. Obviously, this question around housing affordability, but that's for another topic. But the idea here is that we see more activity. The Bank of Canada is noticing it. They're pointing it out. At what point in time, if at any, does more activity in the housing market equate to higher home prices for single family detached homes in certain locations, certain geographical locations, such as Ontario, GTA, Vancouver, Montreal? What does this mean? Remember, we've talked about it. Condo market, whole different entity, whole set of their own problems, dealing with a lot of clients right now. They're having issues with the condos closing, appraisals not coming in. People bought years ago, elevated price per square foot, $1,400-$1,500 a square foot. Things are appraising at $950. Are we going to see obviously some more challenges in the condo market? Absolutely. Are more developers in these condo projects going to go into receivership? Most likely the case. That will happen. But what does that mean for single family homes? What does it mean for the larger, broader sentiment for building as we do face a major headwind? We need more single family homes. We need homes that Canadians want to buy and want to live in, not 400 square foot, as some individuals would call it, dog crate condos, right? I mean, this is literally the conversation right now. So what I want to do is leave the video here, wishing everyone a happy holidays, Merry Christmas, as we embark on this time of year. I think it's very important to just be grateful for those that are, our viewers, obviously, for our clients, and be grateful and cheerful for everything that we have, especially in this time of year. But we'll continue to track all these Bank of Canada rate announcements. We'll be back next week. Just want to remind everyone, if you haven't subscribed, please consider subscribing. It does help get our subscriber base up, help get this content out to as many Canadians as possible. We thank you again. Let us know what you think. Drop your comments and concerns in the comment section below. But we'll see you all next week. Thanks for stopping by.